You think you know athlete paychecks. Wait until you see this.
In the public eye, he's known for speed, power, or gravity-defying plays. But off the field, he moves in an arena where money multiplies faster than the scoreboard. Private equity, global brands, and complex real estate. Today, we're not only revealing a jaw-dropping net worth, $3.7 billion, we're tracing every move that made it possible. This isn't luck or one contract. It's strategy, timing, and the modern playbook for turning fame into an industrial-scale fortune. Over the next 40 minutes, we'll examine early choices, pivotal deals, and the riskier moves that either made him richer or could have ended it all. Stay with us. You'll want to take notes.
From humble beginnings to a breakout moment that changed everything. Every billionaire has a starting line. For many athletes, it's a neighborhood court or a single scholarship that opens the door. We'll map the critical early choices, training, agent selection, and that defining performance that created leverage. Leverage is the currency of contracts, how an athlete uses a single breakthrough to negotiate better deals, attract sponsors, and build credibility. Along the way, we'll highlight mentors, early partnerships, and a willingness to invest earnings into ventures most peers ignored. That combination, athletic skill plus strategic patience, is the first domino in a $3.7 billion story. Contract numbers make headlines, but the real power is in structure. Guaranteed versus bonus-heavy pay, equity clauses, and lifetime deals. We break down the athlete's first major contract and the endorsement pivots that followed. Crucially, some endorsements included equity or board seats, meaning long-term upside, not just one-off checks. He also used deferment strategies, getting paid later in equity or lifetime revenue streams to align incentives with growing companies. Those early, well-negotiated deals seeded later investments and created a partnership-first reputation that attracts better offers. We'll show the mechanics behind turning endorsement checks into company ownership.
With capital flowing, diversification is essential. Real estate, private equity, sports teams, tech startups, each played a role. We'll highlight 3 to 4 marquee investments that delivered outsized returns. Early-stage tech that went public, high-end real estate in rising markets, and a stake in a disruptive brand that scaled globally. He invested selectively, betting on founders, securing board influence, and using celebrity distribution channels to accelerate growth. Importantly, he used leverage, partnerships with experienced operators and capital from institutional investors to magnify returns while minimizing control risk. This is how athlete capital moved from passive to active, creating compounding returns across industries.
Brand building was intentional. Rather than one-off products, he built platforms, vertically integrated businesses that captured more value, design, manufacturing, distribution, and direct-to-consumer channels. Strategic partnerships with retail giants, licensing deals, and minority stakes in manufacturing meant more margin and control. He also bought complementary businesses instead of competing: fitness tech, sports nutrition, and lifestyle media. Owning pieces of the supply chain transformed brand image into recurring revenue. We'll analyze how a single apparel label became a hub for multiple profit centers. Celebrity provides reach. Contracts and processes provide repeatability. He built a deal machine, a small in-house M&A team, a legal playbook for equity for services deals, and a network that funnels high-quality opportunities. Instead of ad hoc decisions, he institutionalized vetting, due diligence checklists, operational KPIs, and trusted advisors. This allowed him to scale activity without diluting quality. We'll show how repeatable deal flow led to exponential growth and how this playbook is replicable for creators and athletes who prioritize systems over spontaneous endorsements. Risk comes from public scandals, bad investments, or over-leverage. The athlete faced at least 2 high-risk episodes, a failed venture and a public relations storm. Instead of doubling down, his team used rapid response PR, strategic divestments, and a rebuilding narrative focused on philanthropy and transparency.
We'll examine how damage control, timely apologies, and pivoting to community projects repaired trust. The lesson: wealth without reputation is brittle, and elite teams prepare contingency plans before problems happen.
Billionaire scale, philanthropy intersects with legacy planning, tax strategy, and reputation management. We'll outline the athlete's major charitable initiatives, scholarship funds, community infrastructure, and how these programs align with tax-efficient vehicles like foundations and donor-advised funds. Legacy also ties into family offices, long-term wealth transfer, governance structures, and succession planning. The goal isn't just headlines, it's building institutions that outlast a single career.
Translate these lessons into maximizing leverage, skill plus reputation, structure deals for upside, equity, board seats, diversify intelligently, institutionalize decision-making, and prioritize reputation. Whether you're a creator, entrepreneur, or investor, the same principles apply. Trade short-term splurges for long-term optionality. Build teams that multiply your time and credibility. Invest where you have distribution advantage.
The empire continues to revolve. Next, vertical tech plays, global market expansion, and strategic stakes in emerging markets. What remains constant is a disciplined approach. Invest early, control key distribution channels, and build institutions that endure. If you take one thing from this documentary, let it be this: wealth of this scale is rarely accidental. It's engineered through strategy, partners, and relentless execution. If you like this deep dive, subscribe and tell us which business move you want a full blueprint for. We'll make it next.